More than $1.9 trillion in hedge fund assets are now managed using AI-driven allocation systems, marking one of the fastest transfers of financial authority in modern market history. Something just changed beneath the surface, because capital allocation has traditionally remained under direct human control even as technology improved execution speed. This type of authority transfer has occurred only twice in the past 40 years. First with electronic trading in the 1980s, and later with algorithmic execution in the early 2000s, but never at this scale. First, I will show you how AI systems now filter and reject trades before human managers ever see them. Next, I will break down how AI-driven credit models are forcing hedge funds to reposition capital automatically. And stick with me all the way until the end, because I'm going to explain to you how AI has begun controlling capital allocation timing itself, fundamentally overriding human investment decisions. Almost nobody is noticing that more than 72% of hedge funds, managing over $10 billion, now rely on machine learning systems to generate primary portfolio signals, rather than human-originated analysis. The most immediate example is trade selection. AI systems now evaluate over 50,000 securities and credit instruments daily, assigning probabilistic scores based on expected return, volatility exposure, and liquidity risk. Opportunities that fail to meet algorithmic thresholds, often below 65% confidence probability, are automatically rejected before human review. This reverses the traditional investment hierarchy. Humans no longer originate most decisions. They validate machine-generated conclusions. Credit markets provide an even clearer example of AI authority. Machine learning models continuously monitor corporate debt across more than 11,000 global issuers, analyzing yield spreads, balance sheet deterioration, and liquidity indicators. When AI detects early-stage credit stress, even shifts as small as 0.35% in credit spread behavior, hedge funds can reduce exposure immediately. Human analysts review after capital has already moved. The machine is no longer advising, it is acting. Capital allocation timing has undergone the most profound transformation. AI systems now dynamically shift exposure across asset classes, including equities, commodities, and private credit, based on real-time macro and volatility signals. Some hedge funds report that AI-driven allocation frameworks have reduced reaction time to market conditions by over 91%. Allowing capital repositioning in minutes rather than days. This timing advantage compounds performance asymmetrically. Scale explains why this shift has accelerated. A traditional hedge fund analyst can fully evaluate perhaps 20 to 30 opportunities per week, constrained by cognitive and time limitations. AI systems can evaluate tens of thousands simultaneously without fatigue or bias. Once deployed, these systems can manage incremental billions in capital without increasing staffing costs, improving both efficiency and responsiveness. This transition represents more than technological advancement. It represents a structural transfer of authority. Capital now moves based on probabilistic machine optimization rather than human intuition. And when machines control allocation timing, human decision-making becomes secondary to algorithmic execution.